Welcome to RyugenTrades. Today is the 18th of August 2024, a beautiful Sunday here in Kuala Lumpur. Episode 35, Trading FCPO or Futures Crude Palm Oil. Well, this channel is all about me sharing my trading journey, and in this episode I'll be sharing my learning so far of the FCPO, trading FCPO, specifically also covering calendar spreads. I'll be covering a comparison between stocks versus FCPO, outright trading of FCPO contracts, and also spreads. Now, I'm a retail trader trying to improve myself by creating videos like this. I trade mainly on the Bursa, US and FCPO. I'm the little anchovy swimming with the sharks and the whales. Well, a quick disclaimer before we begin. This is not a recommendation for you to trade futures. Please do your own research on the product, FCPO, before making any trades. There's a lot of information on Bursa's website and other parts of the internet. Well, if you are on Moo Moo trading platform, you can follow me on Moo Moo. I'm RyugenTrades there as well. And if you think I deserve it, please buy me a cup of coffee. The links are in the link description below. Well, before we begin talking about FCPO, let's have a quick comparison, stocks versus FCPO, because I think most of us who starts off trading will start off at trading stocks, so we're more familiar with that. So let's have a comparison to see what's the difference. Well, number one will be the underlying. So stocks, obviously you're buying a piece of a company that's listed on the stock exchange. In comparing that with FCPO, you're trading a commodity. In this case is crude palm oil, and usually you're trading the contract price of a particular month, and you'll be hearing things like you're trading the June contract, July contract, August contract, and so on and so forth. Well, the next difference is the selection criteria, and this is to me one of the advantages of trading FCPO, because if you look at stocks, even in Bursa alone, there is over 1,000 listed companies to trade, and you have to do a bit of homework to do a selection as to what stocks to buy during which period of time. Compare that with FCPO. Basically, you're just trading one commodity, and you have two common trades that people make in FCPO, whether you trade the outright price of the contract or you're trading calendar spread, and both of these I'll be talking more about later. Next, let's talk about knowledge. Well, in trading stocks, whether you are a short-term trader or long-term investor, you've got to know your fundamentals in terms of the industry that the stock is covering, their prospects as to whether there is any potential upside, whether you're trading growth stocks, whether you're trading dividend stocks, whether you're trading small caps. They are all different in nature, and with that knowledge coupled with technical analysis and news, that will actually form the basis of decisions when you put on a trade. Now, for FCPO, from my perspective, you can trade mainly based on technical, purely because number one, a lot of the traders in FCPO are intraday traders and scalpers. Therefore, the long-term fundamentals of demand supply does not necessarily impact their decision. You will follow the trend of the market of the day. So therefore, you can really trade FCPO purely on technicals, and news will be useful for you to follow, especially those that impact the demand and supply and production of the crude palm oil. So those are generally things that you need to know about in FCPO. Now, direction, generally in Bursa, for example, you can only trade long. There are some regulated short selling or intraday short selling, but these are limited to a few stocks and a couple of rules set by Bursa. Whereas in FCPO, you can do a long or short depending on the direction of the market. And this is an advantage because in times when price of FCPO is dropping, you can do short sell and cover your positions to close off your trade. Now, if you are also currently trading stocks, you would already have a trading account to trade your stocks. Well, this is a different account if you would like to trade futures. You have to open a futures trading account. You can check all the details in Bursa Malaysia's website when they talk about derivatives. If you like recommendation on where to open your futures trading account, you can always contact me privately. I will gladly recommend my current remisier, and he's been the one that has been actually actively sharing his knowledge, having regular sessions with his clients to teach about FCPO. Well, next we talk about volatility. Well, stocks, to me, I would rate them medium to high, comparing that to FCPO, which to me is high, and in certain times I would think very high as well. So it is not for the faint-hearted. FCPO movements are fast and furious. If you think stocks is volatile, well, just be prepared when you go to FCPO, especially if you're trading outright. Changes in contract prices, things will move so much faster. I'll talk about also why then, if you want to trade FCPO still but don't want want to manage your risk better, well, calendar spreads could be something that you will look at, because the same applies. Technical analysis will be applicable, but the movement will be slower than outright price changes, and you can still trade FCPO. And this is the product, calendar spread is the product that is mainly traded by the full-time traders registered with Bursa, which are called local participants. They trade calendar spreads mainly, and they trade in large volumes. And the risk is manageable. They will add size to their position, meaning adding contracts when the direction is in their favor, and that's how they make money. Now, after you've opened your futures trading account, the first thing you'll be asked to do to trade, before you can trade, is to deposit a margin. So depending on how many contracts you want to trade, per contract the minimum margin is 7,000 ringgit for outright, whereas for calendar spread is 3,500. So this margin, you have to remember that it changes over time, and this per contract. So the more contract you want to trade, the more margin you have to deposit. And of course, it is not a minimum. You have to buffer in changes to your balances. So therefore, even if you want to trade one contract, 7,000 may not be enough, because you hit a margin call immediately if the trade is going against you, if the market is going against you. So bear in mind, this is the margin requirements. Now, volatility, as I mentioned, FCPO is volatile, but of course, if you compare outright versus calendar spread moves in a much slower pace, and it's something that is more manageable in terms of risk. Trading style for outright, if you love scalping, you are intraday trader, or outright is maybe something for you, compared to if you are preferring to do swing trading. Well, calendar spread is something that will be more suited, because movements will tend to happen in between few days to maybe 1-2 weeks. Now, who is it for? For trading outright, I would imagine it's really for full-time traders, or those who can really monitor the charts, intraday charts. And if you are not someone that can do that, you have a full-time job, you are in and out of meetings, you are always on about, you can't really refer to your screen to look at the charts, well, maybe calendar spreads will be a better fit for you. And for one of the things that makes FCPO volatile is it's common to have gaps, whether gap up or gap down, in between sessions or overnight. Whereas calendar spread, the movement of the price is much more orderly. So later on, I'll be showing a chart so that you can see how the movement is and explain why is it moving in such pace. And finally, we talk about contracts. Well, in FCPO, we always talk about contract months. So now today is 18th of August, we are trading the November contract. And normally the active month is the third month, and the cutoff of the contract month is not based on calendar 1st and 30th of the month. In FCPO world, the last day of the contract is 15th of the month, whereas the new month of contract starts on the 16th. So between 16 to 15 is a new contract month. So now we're on 18 August, so the active month is November. So if you're trading outright contracts to have better liquidity, you've got to trade the active month. If you're not sure which is the active month, just find out which contract has the most volume at any point in time. Very importantly, if you are new to FCPO, do not trade the current month or the spot month, because in the contract specs it will state that the settlement of the FCPO contract is via physical delivery. That means physical delivery of the crude palm oil. And finally, we talk about calendar spreads, which is the active month. So the active month is the same. If it's now, it'll be November, but the calendar spreads, you would have two contracts. You will get two contracts at the same time, so you'll be getting the active month and active month plus one. So for currently, if you're trading now in 18 August, the pair that you'll be trading will be November and December. Let's move on talking about FCPO trading the outright contracts. So first thing first, if you're new, you probably won't know this. The smallest unit for FCPO, we refer it to as 1 tick. So 1 tick is equivalent to 25 ringgit. So FCPO price now is around 3007. So assuming if there's a movement between 3701 to 3702, the movement is up 1 tick, so that's equivalent to 25 ringgit. And based on current trading range, the movements can be anywhere between 50 to 100 ticks per day, per contract. So if you have one contract, the movement can swing from 1,250 all the way to 2,005 a day. So this is the kind of range that we're looking at. And imagine if you are trading based on 7,000 margin, this is a high percentage, and this is happening every day. So the movement is quite volatile, and that is why it attracts a lot of retail traders who are interested in doing scalps and intraday trade, because the action is really fast. Price action can you can hit your target price and stop loss all within seconds to minutes. So because of this volatility, if you are doing scalping or intraday trading, it's mandatory for you to have a stop loss set prior to entering the trade, so that you can maintain your account balance and maintain your margin for the next trade. Now, chart time frame, it's usual for FCPO to go down to the 1 minute chart, 5 minute chart, 15 minutes, and 1 hour for the longer time frame trend. And if you are trading Bursa, if you try looking at the 1 minute chart for some stocks or most stocks, you would not see much nice charting for you to do your analysis. And last but not least, a reminder again, contract month, always select the most active contract, which is those with the highest volume. And to do that, just add 3 months to the current month. And remember, the start of the month is actually 16th of the day of every month. Now, to show you an example of a trade for FCPO, this is a FCPO chart on TradingView. I'm using the 1 minute chart. And for illustration, I just took the recent last Friday's chart, which is Friday the 16th of August. So assuming that there was a long or buy position at 12:20 p.m. at 3715. This is when you're smiling, entering the position, because you're seeing, ooh, it has found the support and tried to bounce back. So you're trying to catch the uptrend back to a higher level. But you hold it over the lunch break, and by 2:30 when it opened, it gapped down and eventually it hit your stop loss at 3700. So what this means is you lost 15 ticks and 25 ringgit per tick. That is equal to 375 ringgit per contract, and all this within the matter of 14 minutes. Let's compare it with a stock. Let's say I've picked Berjaya Food, and this is a daily chart. So daily chart for BJ Food, and this scenario, the person probably interested to buy BJ Food because looking at higher high, higher lows, and trend looks to be going up. So it's all well and good. So I have two scenarios here to see how fast can you lose the same amount of money, 375, in these two scenarios. Now in scenario 1, which the buy was 24th November, in this case I just put an example of 1000 shares at 1 ringgit. So how long did it take for this particular trade to lose 375 ringgit? So the price went down to 62.5 in 22nd May 2024, and that's 6 months later. So it took 6 months to lose the same amount of money. In scenario 2, I basically have the same time of buying, 24th November, but this time 7,000 ringgit, which is equivalent to the margin for FCPO. So you put in 7,000 ringgit and you hit your stop loss at 95 cents and lose 350 ringgit, and this is also happening within 13 days, and compared to FCPO you lose about the same amount of money in 14 minutes. So this is an example of how volatile, how fast FCPO outright trading can be. Let's move on to FCPO spread. So the chart time frame that I use currently is 15 minutes and the 1 hour chart. And as mentioned earlier, the calendar spread chart, the price will be different from the outright price chart. And the two concepts that you need to understand is the when to short and when to long. And what is it all about? Now, when you short a calendar spread, basically what you're doing is, if you are trading the November-December pair, you are actually selling the November contract and buying the December. If you're going long, you are basically buying the November and selling the December contract. So why would you short the market? So if you're anticipating the November contract to go down more than the December contract, then that's when you would sell. Or if you think that if the current November contract will go up more than the December contract, then you will go the opposite side, which is go long. So basically it's all about perspective, but this is all to do with short-term demand and supply. But if you're trading purely technical, the charts will show you the direction of the spread. So you may or may not need to know. It's up to you whether you want to have the additional assurance of understanding where the market is heading for the current and the far month, the price of the near month versus the far month. If not, purely trade on technical, look at the charts for your trade, set your stop loss, set your target price, and that's it. That's your trade. So let's now switch our attention to spread trading. So essentially what spread trading is all about is you're trading two contracts at the same time, and in this case I'm showing you the 1 hour chart for CPO November contract, which is the blue line, and we'll be trading with the spread pair will be the December contract for FCPO. So this will be shown by the red line. So we've got the blue line, which is November, and the red line, which shows the chart for December. And what we're trading for spread is essentially the difference in these two prices. So when you're entering a spread, you're buying one contract and selling the other contract. So depending if you are bullish or bearish, the spread will move accordingly. And you can see now the difference now is between November and December is 23 ticks, 23 points. And this 23 will be shown in the spread chart and the pricing for spread November December contract. So as you will see here, initially the spread difference is not a lot. It was around 5 to 7, and eventually it got all the way to currently 23. So that actually shows that the spread price, the difference, the gap between these two contracts has increased. So if you're in a long position, you would be in the money right now. And just to compare, in the earlier months, earlier period before this, the price was moving in tandem and therefore not much activity then. Moving along, I'll show you what the trading platform will show. In my mobile app, this is what it will show. For the November-December spread contract, the bid was 23 and the ask was 24. Whereas for the outright price for the November contract, it was 3675 versus 3688. You notice it's very different. So if you're trading spread, you don't even need to know what is the outright price. So on the bottom left, you see this is the spread contract price chart. It is a clear uptrend, and I did buy at 7 and close it at 17 last week. So it was a 10 ticks gain, but if I held on a bit longer, it would have been much more because it went to a high of 25 and eventually closed at 23. In contrast, that to the November chart, you see is a clear downtrend there. And important to note that you will notice the chart for spread can go to 0 and negative, and this means for the current month contract versus the near month versus the far month, the difference will be negative, meaning to say the near month is lower than the far month. Now let's move on to the outright price. It last closed at 3680, and you'll notice the range is almost about was it 200 ticks from the current price to the high. So if you're trading outright, that is the risk that you're taking. 200 ticks is 5,000 ringgit, and that's over a couple of weeks. Well, we've come to the end of this video. I hope my sharing has been beneficial. If you think you have a friend that would like to learn about FCPO and you find this video helpful, do share it with your friends. I thank you so much for watching. If you're new to this channel, do subscribe, like this video, give me a thumbs up, and press on the bell for notification for any new videos. Again, thank you so much. I hope you have learned something. Have a great trading week ahead. Bye.